I am here with Saul Cohen, and he is a partner at The Expert Eye. How's it going, Saul?
I'm really great. Thank you so much for having me on, Steve.
Yeah, I'm excited to really unpack this for everybody listening or watching. I think when it comes to accounting and exits, it's really sometimes confusing for a lot of people, and sometimes it can be daunting when they're operating day to day. So I'm excited for this episode. But before we get into kind of the tactical aspects, let's talk about you. Let's talk about your background and how you got started.
Sure. So, I'm an entrepreneur by nature. So, I've always loved entrepreneurship. My dad he sort of had his own business. It was a small sort of one-man band, but did really well. Looked after us. It was, enough to give us a good life that I'm very grateful for. I always looked up to that. I loved the idea of entrepreneurship. The more I learnt about it, the older I got, the more I loved it. And then I was always very creative, but at the same time very interested in business. So trying to pull those two things together, and I think entrepreneurship does that really well. So I did economics, loved economics, found it really interesting. It really sort of changed how I looked at the business world a little bit. And then I started my first business when I was at uni. It did really well, not necessarily making billions like I assumed it would, but it definitely funded our uni degrees. I did it with another colleague, and it did well enough for us. And then I went off to PwC to be an accountant, and I thought, do you know what, I want to learn everything there is to know about business and entrepreneurs and what it's like to work with entrepreneurs. And so that's what I did, and I thought the best place to do it as an accountant, as an advisor. And so I went to PwC, I trained with them, worked with some of the biggest companies in the world, on all different sorts of engagements. I started in assurance, as many people at PwC do, which is basically like audit. And one of the best things about that was I moved out of audit quite quickly, so quite early on in my journey, and I moved into sort of risk assurance. And it was a very subtle change at the time, but something that one of the partners told me early on has really stuck with me and carried with me in my career. And he said, the most important thing that you need to understand is that ultimately, if you understand the core fundamentals of audit, then you understand any type of assurance program that you will ever be given. And that is, if you understand what the fundamental risk that we are looking to review is, and therefore what the likelihood and impact of that risk is, then we can assess how big a risk that actually is. And also, we can look at mitigating features. And so we can try and, basically, if you understand a risk, you can measure it and you can try and control it. And that I've carried that with me in everything I did. Loved the work I was doing at PwC. It was great. But then I think around the time that my dad came to sell his business, I realized that there was just this gap in the market where SMEs, small business owners who are really, they are the lifeblood of the economy. They are the people who really like push innovation and keep things moving. And, sometimes they run these boring businesses or whatever, but they're the ones who are really creating value. They don't get the same level of advice that these big companies get, and that's a shame. It's a massive shame, because it means that those entrepreneurs who are the bulk of the successful market, right, they don't actually get rewarded in the same way as they deserve. And I looked at that and I just thought, do you know what, it's a shame. It's a massive shame, and I need to do something about it. And so I left to start my own firm, literally to advise business owners on the journey to exit. As a result of that, and what I was saying before about me fundamentally just trying to get to the bottom of what risk we're actually trying to understand, got very involved into sort of the acquisition world. And yeah, now I'm running the firm as I said before, we were talking. I'm actually just about to publish a book on the acquisition journey, and I'm about to embark on sort of a couple of private equity boards that I've been invited onto as well. So it's been an interesting journey, but I'm sure it'll be more interesting in the coming years. But I think that the key thing for me has been just that thing that entrepreneurs are amazing people. I could not respect them anymore, and I just really wanted to I wanted my contribution to the world, the piece of value that I left on the mark, to be that the people who are working on changing the world for the better, I'm looking after them, because if they're looked after, they're going to look after everyone else.
That's right. As a fellow economics major, I totally totally understand that the small business world globally really supports every economy, like the amount of jobs, the amount of spending. When you spend in like a local business, you're supporting jobs, you're supporting literally your community around you dramatically more than franchises and stuff like that. So definitely firm believer in that. And I'd love to
Absolutely.
get into the prepared aspect, because for everybody listening, maybe you're brand new to the show. I think it's important to know that there's a couple different types of accounting. And we were talking about this before we were recording. There's traditional accounting, and then there's M&A style accounting. These are very different, and they are often not viewed as different from entrepreneurs that are operating. They're working with the same accountant for many years, getting the books, organized for tax purposes and stuff like that. But when it comes time to prepare for an exit, I'd love to start here, Saul, if you could, like kind of walking us through what is different about going through an exit and preparing.
I think when you're optimizing for different things, and I think that's the most fundamental difference that you need to think about, right? I'm a big fan of being intentional about the direction that you're moving into, so that you can because you can only optimize for one thing at a time. It's the classic one is that entrepreneurs normally want to optimize for low tax bills, right? But then when they want to sell their business, or they want to get a mortgage that they can get some, buy a property, suddenly now they need to optimize to show a lot of profits so that they can, we've got loads of income, and those two things they conflate. And I think that's the fundamental thing, right? So we're optimizing for different things, and therefore what we're looking for is completely different. The fundamentals are similar. And so you might be forgiven for saying, "Oh, well, actually, you're doing the same thing," but what we're actually doing is different. I'll tell you why. Because valuation is driven by different things, not just the numbers, right? And a accountant who doesn't necessarily have the opportunity to go through acquisitions day in, day out, maybe they're seeing one a year, if that. They just, because they're not seeing that many acquisitions, they won't understand valuation in the same way. And so what they'll do is they'll prepare you a set of accounts. The set of accounts might make sense. They'll be able to explain it to you. It's probably tax optimized, but they won't be able to explain how that's going to affect your valuation, because your valuation will depend on so much more than just the numbers. The numbers are a part of it, absolutely. And how they interact and interplay with sales purchase agreements, etc., and the structure of your deal, all of those things can have an impact, but they won't be able. They just will not get this point about risk, or at least in my experience, I find it's incredibly rare to find sort of day-to-day accountants who really understand valuation, the interplay between the numbers, risk, and valuation. I think it's really rare.
Mm-hmm. Agreed. So what are some things that people listening now, if they're operating a business, what are some things they can do to prepare their books if they're thinking about, 2-3 years out?
Okay, so first thing is just have a basic understanding of how valuation works. And At a very basic level, forget everything you think you know about valuations, because it's massively manipulated by the top end of the market. And at the top end of the market, you need to appreciate that they're selling something completely different. They're selling some kind of competitive advantage or specific IP in that business, and therefore the multiples that those businesses are going for are materially different to the multiples that a normal business will go for. And a normal business will go for a multiple, which means I'm going to assign a risk value to your business based on what I think it's going to generate in terms of profit. So we look at what cash can you generate. If you think of a business as a cow, we're looking about how much milk is it going to generate, and what's the risk that the cow is going to continue to generate that milk into the future. Right. So if I want to value a cow, I'm going to do that. I could value the cow at the cost of its meat, but generally it's going to be worth much more as a milk producing unit than as a carcass. And that's exactly the same for your business. And to do that, we look at the health of the cow or the health of your business. And when I wrote the book, I sort of came up with a rough framework for it. So I call it SCORE, the SCORE framework. So it's basically systems, your clients, so systems in the business, like a way of working, a way of delivering your work. Clients, so how do you look after clients? How do you nurture them? How do you get them? Basically, what's your process for winning work? Organization, so the structure of your team. So structure, this is the R, so it's a bit of a cheat. But that's basically about your structures in the business that make it less risky. So do you have legal frameworks, or do you have any recurring revenue, or particular IP, or software that you might have developed, and any particular risks or exposure in the business. So is there anything in your business that for example, let's say there's a HR claim, or you've got some legal cases, or you've got arguments with people in the market, or the market is on the way down and you're inherently exposed, something like that. Where are you exposed as a business? Right now, supply chain is a big one for all businesses, so that's obviously going to inherently affect valuations. So that's my broad stroke. What I think is really important for most business owners. The fundamental it depends on the size of the business, but smaller business owners, the biggest problem is that they are a 5-star employee. No one is as good as they are. They're really humble, so they probably don't see that, but they can't be replaced. And so the question is, what loss is you leaving going to have? And so if you've got a client acquisition process that does not involve you, there's no point me saying, oh yeah, well, Steve, how do you get your clients? And you turn around to me and I'm like, oh, well, look, they're all just people who know me because I'm so great. Well, that's good for you. But when I come to buy your business, it's got no ability to win any work because no one knows me. And so you need to have a process that's evolved of you. If you've got like ideas in your head, similar for me, there's no point me turning around and saying, I've got all these ideas about how valuation works. But if no one in my team knows it, if I've not been able to articulate it, write it down into set processes and a way of working for my team, then the business's IP is inherently valueless because as soon as I leave, it goes. So I think that those are the two biggest things, probably, because they are the biggest generation, right? So we've got demand and supply. We've got your ability to continue winning work and your ability to deliver a good value service. Those are the biggest things. And then everything really else is sort of support structures for those two things, right? So do you have recurring revenue, and do you have a client process, and all of that sort of stuff? Yeah. All
right, nice. And I think timing is another one that comes up. Obviously, every industry, every person, every business is unique and different. But when's the right time to sell?
As soon as you want to. And what I mean by okay. So there's three answers to this question. So I'll give you all three. Right. So the first thing is, as soon as you think I'm going to want to sell in 3 years. Okay, prep for sale now. Do it now. You're probably a bit late already. Get it done. Because what that means is in 2 or 3 years, you're going to have sold out in the business. You're going to be mentally tapped out. You're probably already started to mentally tap out. You're not going to have the energy to prep for exit. Your valuation is going to take a hit because you won't have prepared. You're just going to be dying to get rid of the business. You won't say you're dying to get rid of the business, but practically you will be. You'll feel like your life's in a rut. You're just going to be all over the place. You'll be really tired. And I see it all the time. I see it with business owners. It's all too often that they come to me when they're coming to exit and they're like, well, we need some help. We just need to leave. And we just want to retire. We want to go off and travel the world. The crazy thing is, no one's lasted longer than 2 years without calling me back saying we've started a new business.
Yeah.
Right. They're not tired. They're just tired of that project. So that brings me on to the second one, which is, I think in an ideal world, you probably would start a business, scale it to a certain size, and sell it every 5 to 10 years. And the reason why I say that is because one of the best things about being in the job that I have is that I see what happens after the exit. And what's really crazy is after people sell their business, the next business that they start, they scale to the same size or bigger in a fraction of the time. So if you grew a business to, let's say, 3 million, and that maybe took you 10, 15 years, the next time you'll do it in a year, maybe a year and a half. And it sounds crazy, but the fact is you just know the journey up the mountain now. And that path is so well trodden for you, you can do that in your sleep. And so the question then becomes, can you go above that? Or do you even want to go above that? Maybe you just want to keep doing that, go up to that level, sell it out, and then come back and do it again. And I think normalizing that is something that's valuable. There's lots of good reasons why people don't, but I do think that's another really good reason to sell. And the last one that I was just going to add is that sometimes there comes a moment in the market where multiples have just shot through the roof. In the UK, it happened for vets a few years ago. So veterinary sciences, their multiples just went from a normalized multiple of maybe 4 or 5 because it's mainly recurring work, really sticky, so really high multiples. It just flew up to about 12 to 15. And that was because private equity were coming in and consolidating. I've got a potential client who's talking to me at the moment. They are in the insurance space, and theirs is right now really similar. So despite the fact that the normal multiple for that kind of business might be like 3 or 4, right now they're getting offered a multiple of 12. And at those moments, those are the times to sell, because holding on at that time is not going to make you any more money. You're probably going to lose money. You'll probably work for another 8 years, and then you'll sell out at a normalized multiple, and you could have got all of that money now. So definitely, that you need to know when that moment comes in the market, when that's happening. Just take the money and start again.
Yeah, the macro. And I had advice many years ago from a mentor of mine that when I was approached about selling one of my first venture, he said, "Steve, are you going to do it again? Are you going to start another business?" And I was like, "Yeah, I probably will." And he was like, "Okay, well then move on." and it's such valid advice. And like you said, the next venture and the next venture, sort of optimizing because where the pain is as you go up the mountain, is a great segue into mistakes. So my favorite topic is, what mistakes have you seen over and over and over again that entrepreneurs make while they're going through the process?
Well, it's quite reassuring because I've made all the same ones. I think hiring for the wrong reasons, hiring without planning. The most painful mistakes generally come from team. I've got an employee who actually used to run his own firm, and he often jokes to me. He's like, there's an old curse that he was told of, may you have many employees because the more employees you have, the more problems you have. And there definitely is some truth to that. Hopefully not too much, but yeah, there is some truth. The biggest problems that you will have in the team will be either a leadership problem on you or a team problem. And I think that's the biggest mistake. The other one is trying to do everything alone, because I think we forget how little we don't know what we don't know. And I think it's really important to surround yourself by people who do know and who can advise you, get a big business coach, or, be in a mastermind, have that sort of thing. I think there's tremendous value in it. I think it's also about the person that you become, the leader that you become. Even in an AI world, it might be that we're looking at smaller teams, but businesses for the next few years certainly are going to be about running teams, and aligning with the right people and the leader that you can be. So I think all of those things are really important. I think those are normally where the mistakes come from. Occasionally you have other mistakes, like, okay, I didn't have an accountant who told me that I was going to run out of cash. But I think with those, again, it's a leadership problem, really, because if you were a more advanced leader, if you look at, like, if you had a mentor who'd been higher up the mountain than you, and he could or she could guide you in that way, they would have told you, make sure you're on top of the numbers, make sure you're tracking financials, make sure you're staying focused, all the problems that you've got. So I think any mistake in business will always come down to number one, i.e., I just need to be a better leader, I just need to be a better business owner, and then it sort of filters out into the little sort of categories, I suppose.
Yeah, I like that. And before we get to the finale question, I want to bring up due diligence. Like, what are red flags? Like, what flags do you throw when you are in diligence, or when you're talking to entrepreneurs that are going through diligence? What kind of alarms go off for you?
Okay, this I think it would probably shock a lot of people. I am different with so we've done over 150 deals, and there are only 2 deals that I've seen fall through because of red flags and DD. There were a couple of others that had fallen through. We had a deal where, like, it was a tech company, and they just looked at the tech behind what they were buying, and they thought, this is all nonsense. So that's different. But generally, if we're talking about normal business, and we're financial DD, for me, the most important thing is trust and transparency. And the deals that I've seen fall through, the concern when I've got a really big red flag and I'm turning around and saying, listen, I don't know if you want this deal to go ahead, only ever exists when I feel like the seller is holding back information. They're not being forthcoming with, like, what's actually going on. They're not in control completely, inadvertently. It's not that they're trying to hide anything. They've just got no control. They're an absolute mess. The finances are all over the place. It's taken them 3 months to get us a set of accounts that should have taken maybe 6 weeks. They're not giving us bank statements. They're not giving us the information that we're asking for. And some stuff, I understand, takes time and is a big burden on the business. And some stuff should just be at your hands, and we should have it in a few days. There's no reason why we haven't had it like 4 weeks in. And I think that is the concern, right? Because ultimately, acquisitions is about trust and people. And I think when that trust breaks down, the whole deal breaks down, and it just becomes far too risky for us to take this on. Everything else, without fail, everything else that I find, we need to write off debtors, or we need to write off the inventory, or you've got no way of winning clients, or whatever it might be. There's no recurring revenue, quality of revenue is terrible, whatever it might be. Everything else just becomes a negotiation tool that will go into some clause in the sales purchase agreement, or will change the valuation on the business, and the business will still go through. Because ultimately, as much as we all think that business acquisition is about the number and getting a big payout, and that is definitely a big part of it, it's more about the people and wanting to do a deal between 2 people who get on, and we just think this is right. And so for me, due diligence is much more about let's find the negotiation triggers rather than it being about should this deal go ahead or not. You know, that's definitely a part of it. But as I say, it will only, in my view, the only big red flag is if just there's no trust.
Yeah. Trust is sort of the foundation. Totally get that. So that takes us to the finale. Knowing what you know now, what would you tell Saul 10 years ago?
Yeah. Well, I'll tell him to take some responsibility and know that everything is on you, and don't blame other people for mistakes that happen. If something's not going right, it's on you. You're the business owner, you're whatever it is, you're the leader. You have to step up and move forward. And I think that is a really important part of business, right? You know, because sometimes we get in these, but everything, life's about ups and downs, right? And we grow through the downs, and that's fine and that's okay. But I think the most important thing in those moments is to remember that actually I'm in this down because I'm being taught a lesson, and I need to grow through it. And if you're in this headspace of blame, and you know, I can't believe they've done this, and it's all their fault and whatever, then you're not going to grow through it, and you're not going to get what you need out of that process. So I think that's really important. And the other thing I think that not necessarily, I suppose even for me it would have been really good is just to understand valuation and stay on top of the valuation of my business from day one. And you think it's like really irrelevant, but actually the assets that we build, you know, the soft assets that they don't necessarily sit on the balance sheet, but they are valuable, and they add value to the business. They should be built from day one, and you know, those are really important. And if I'd have known that from day one, my first few years in business would have been a lot less painful.
Well said. Well said. Well, what are you working on now at The Expert Eye, and where can people learn more?
So I am currently, well, actually we're doing some work with US clients, a little bit of consulting. I've just finished my book, which is coming out in a couple of months. So I will give you a link for that wait list. I'm always active on LinkedIn as well, so feel free to come and follow me there. And as I said, the big thing right now is we're looking at a private equity journey. So I'm working with a couple of partners on that, and looking to do some roll-ups in of the space of my own. Because, do you know what? At some point, I've seen so many people do it. It's time for me to roll my sleeves up and try and learn from the mistakes that I've seen. But I'm sure I'll make some new ones.
Yeah, for sure. That's the way to do it. Learn as you go. That is the way.
There we go.
Well, wherever you guys are listening on iTunes or Spotify, the links that Saul mentioned will be in the show notes. Thank you so much for coming on and sharing all your wisdom.
No worries. Thank you so much for having me on. It's been great.